When it comes to all things silver, there's a few experts I count on, and today I have one of them on my brand new show with me. He is David Morgan of the Morgan Report. David, welcome to my new show here at Stansberry Research. Good to see you.
Well, thanks for inviting me. It's great to see you as well.
Well, I'm sure a lot of silver enthusiasts will be happy to watch this interview so we can get some sort of direction and sentiment from you of what is happening in the silver space. Just when we think, or just when these investors think they can get excited, it's almost like that candy is taken away from them once again, as so much volatility continues here with the silver price, David.
Absolutely. Well, as you know, Daniela, we had a big dip in March. In fact, silver on the futures market hit somewhere like 12. And then it rocketed up and we actually got up to almost 30. And then we consolidated around the $27 level. Mm-hmm. And during that time where there was a lot of physical silver purchases, a great deal was going into the silver ETF, the SLV. And the retail prices had gone to the spot price with huge premiums on top of that. And it really didn't slow the market. People were willing to pay these large premiums. And we saw this big move in the COMEX warehouses where we saw an offtake that was rather significant going into the ETFs. And then we had a setup that looked like it could continue into September. And a lot of people that were, let's say, a little over enthusiastic, right, we're projecting that we might see, a really big short squeeze. I didn't. I said it's business as usual. In fact, we'll probably see a consolidation. And if I was going to guess, it's going to come down. And it did. And now we are in another consolidation. There was a great inventory buildup when silver was, sub 18. I mean, a lot of people don't realize how much silver was going through the system and being refined. And the buyers of last resort are the bullion banks. So they pay, a touch over spot and they put it in the warehouse.
Well,
and so this, doesn't need to be worked off. I mean, it's really tough because, I'm a silver bull and people say, well, I don't like David anymore. He says, the truth is that there wasn't a big inventory build. The truth is also that we've had a huge amount of investment this year beyond what we've seen in many, many, many years. So the physical supply is tight and the silver price is going higher. It's just that unfortunately, at least from my perspective, the paper markets still have control. And I think there's still enough physical silver to keep it in control for a while longer. So that would be my main outlook.
Wait, I want to just elaborate on the point. When you say the paper market still has control, what do you mean by that?
Well, the price setting mechanism is from the futures market, primarily COMEX. Of course, the London Fix also does help set the price. And so these are basically paper contracts that are settled for fiat. But on top of that, there always has to be the correct amount of physical that will be delivered from time to time. And most of the time out throughout the entire futures market, less than about 1% of the amount of contracts are actually delivered upon. If you're talking about soybeans, or you're talking about cotton or cocoa or coffee or silver or any of these commodities. Now, the metals are in that range for a lot of the time. This year, it's very different. Now, there's been so the metals are different because they're money, or at least I look at them as money. So the delivery equation on the metals is higher than it is on a lot of the other commodities that mostly settle for paper only and physical. I mean, you have to have physical commodity. You can't drink, dollars worth of coffee. You have to have the coffee. Anyway, I digress. The point is that we've seen an influx of conversion from a contract into physical beyond something that I've seen for years. So the amount of silver physical into the ETF is substantial, and the amount of retail purchases is beyond something we've seen for a long time. If you add those two together, you've got a very significant increase in physical holdings of silver now. The backdrop on that is that there was a pretty good buildup over the last few years. So the market is able to meet the physical demand presently. That's the point. If we get to a point where it cannot be met, then you will see this explosion like you've probably never seen. A lot of people think we're right there. I differ with that view. I think we still have some time before that takes place.
Like by time, is it a few years, you think, David?
That is so tough. I mean, I was absolutely convinced myself and probably my followers that we were there back in, probably 2006, when we had only 500 million ounces of inventory left. And the market was really starting to catch some steam. And, if you look at the chart, whatever, it looked like we were going to go. And we did go. I mean, we went from, that $9 level to 21 down to 9, and then from 9 up through 50. I mean, we had like a 500 or 600% increase in the silver price. So it was substantial, but there wasn't enough physical to take care of business along that route. Anyway, look, price is supposed to set the price is supposed to arbitrate between the amount of physical soybeans and those that really want it. And that's true of silver or anything else in our system. So you're never going to like get a shortage of where, it can't be had. It's going to just have to come via a price mechanism. And the price mechanism sets the price for a piece of paper, not for a piece of silver, with the exception that those few that want the silver have to be able to obtain it at that paper price. That's the point I'm making. And I hope I'm not confusing anyone. And that has been disrupted. It's been disrupted a couple of times. It happened in the financial crisis of 2008. The premiums on silver went sky high and it subsided. This time the premiums for retail silver has gone sky high and it really hasn't subsided yet. Some of it's legit. Some of it, I think, I hate to say it, some of these people are my friends. I'll be very vague that some of them are probably adding on a little more than they need to. But regardless, there is a supply squeeze on the retail side, but not on the commercial bar side.
Oh, okay. So I want to ask you this for investors, because we saw the crunch, back in April, where people were having issues getting hold of, physical silver, actual coins and bars. What are you seeing now? Is it still tough, or can you get your hands on?
It's still tough. It's loosened up somewhat, and there's a huge opportunity. I mean, for a mint or an entrepreneur to take those 1,000-ounce bars and turn them into 10-ounce bars or 100-ounce bars or coins or whatever. But, people are reluctant to do it because the silver market is such a small market. Any change at the margin can change rapidly. In other words, you build a big factory, you get all these presses in, it takes time to do this stuff. And all of a sudden you're going to pump out a bunch of silver coins and the market dries up. All of a sudden, like everyone that wants silver coins is bottom and the demand just goes away. And I'm making an exaggeration to prove the point. I mean, the mint was very remiss, in my view, of pumping out as many silver eagles as the demand was. It took them a long time before they started minting more on an annual basis than they started with. And then it got to a point a few years ago where they basically shut some of them down because the demand fell off. So now they have, hard capital, something that produces a silver coin that is sitting there collecting dust because the demand is low and there isn't a need to run the press, or that particular press. They're running 10 instead of 20 as an example.
David, let me ask you this. We often hear, well, look at the run up in gold, and when gold keeps this momentum, silver will follow suit, right? We always hear this kind of reasoning, but why would it when the fundamentals are completely different between silver and gold?
Well, I would say it differently, Danielle. I think the fundamentals for silver and gold are somewhat similar. I mean, I consider them both monetary metals. Others don't. And the advantage for silver is the industrial demand doesn't go away, and that's 60% of the market. So you have a dynamic in gold where if it runs up high, then the subset is, well, what else can I get that provides what gold does? And that's, real money. It's tangible, it's fungible, it's divisible, and it's recognizable, and people have coveted it for thousands of years. So I'd say, yeah, it follows gold because it's gold's little brother, it really is. I mean, I love to say silver is superior to gold. In my view, in some ways it is, but as far as the markets are concerned, gold is money. That's a given. This establishment, knows that gold is money. Even Bernanke, when he was asked by Dr. Ron Paul if gold was money, and he had to fumble around and say, no, it's tradition, he knew damn well it was money. Silver, it's been pushed to the side. It's an industrial metal, but it acts as money at times, and in my view is because of the properties that it holds next to gold. So I think there is, here's the fact, whether you think it's money or not, or just industrial, there's an 85% correlation between gold and silver. So if gold goes up, silver goes up 85% of the time. If gold goes down, silver goes down 85% of the time.
Fair enough, David. So for investors watching, what is one to do? I guess from what I'm hearing, if you already own a good amount of silver stash, maybe are you suggesting you wait it out? And if maybe you're new to the game, you want to start adding to your portfolio, what is one to do here?
Great question and tough to answer. I would say if you are not exposed to the metals, you probably could start with silver because the ratio is still pretty high, gold silver ratio, and get in and just start to accumulate. I think that's the best thing. If you've already, loaded up on your metals, even if it was at, $30 silver, I'd say we're still going much higher for the next few years. Just hold what you have. I mean, a lot of people don't balance their portfolio properly, in my view, because a lot that get the gold story see it as like that's the only thing left standing. And I think we're going to be in that direction momentarily. I mean, meaning that these pension funds that move into gold, these retirement funds, the general stock market falls off heavily. There'll be a run to gold, I think, that's never been witnessed before. I truly believe that. But if you look at it from the 30,000 foot level and you look at it, let's say from a chart perspective, you're going to see this huge inflow into the precious metals, like what happened in 1980. But it's an event that takes place that's very short-lived because the monetary authorities on a global basis are already designing the next monetary system. And in my view, it's going to be a cashless system that's based on the blockchain where everything is traced, tracked, and taxed, and there's no way out of it. So that's the system. Now, whether gold will be connected to that system or not remains to be determined. I can almost guarantee that silver won't in an official way, but as you know, way back when you were, I think, the first to interview me on the Load Project, there are systems like that that are blockchain based that do adhere to a precious metal such as silver. And other things that are, hard commodities on the blockchain. So very interesting times. I do believe in competing currencies. They do exist and they will continue to exist. And it's going to be very interesting to see how the monetary authorities integrate their blockchains with those that already exist and how that melding will go about and what the, let's say, jurisdictional mandates will be.
David, last question for you. Physical silver or silver miners or silver ETFs?
Right now, silver. The XAU and the HUI have barely outperformed the metals themselves this year. So it's a lot safer to own the metal than to own a miner. In the longer run, when let's say the physical market gets extremely tight, and I believe it will, even on the silver side. In other words, commercial bars, you just can't get it. I mean, it's just the price keeps going up. Then there'll be a run into the next best thing will be the miners. And then, of course, the larger money and some of the retail investors will move into the ETFs because you can move into the ETF with substantial amounts and they'll move, but not like you would in a small stock. So you'll see a lot in all three areas. It just will be first, second, and third. I think it'll be first metal, second miners, and third ETFs.
Good. David Morgan, so actually one last thought. When you're talking your forecast and your bullish silver, will it blast through its previous high of close to $50 an ounce?
Yeah, I've studied the markets my whole life, and normally a ceiling or what they call resistance level usually needs to be penetrated 3 times as a minimum. This would be our third attempt to go through the $50 nominal, just a number, 50. 50 in 1980 was worth a lot more than $50 in 2011. But regardless of that, chart-wise, yeah, we'll get through 50 this time. And, I said in 2003 or 4, 100 was my target.
Right.
And I think it could go beyond that. But, you know, you look kind of foolish until you get through 50. We'll see.
All right. Well, I wish you luck with that call. David Morgan, talking all things silver today. Thank you so much for joining me.
Great to be back with you. Thanks.
And thank you for watching. We'll have much more for you. In the meantime, follow us on all our social media platforms, Facebook, LinkedIn, Instagram, Twitter. We are there. Thank you for watching. I'm Daniela Cambone.